Did you trade US markets or you traded your own markets?
Yeah.
I think that first slide was something, Marius. It was such a lovely slide. In fact, I have taken a screenshot of that slide. I'm going to take a printout and put it in front of my desk. So, when we talk about acceleration, is there any number you have in mind that this defines the acceleration? फेस टू फेस के एक और वीडियो में दोस्तों आपका स्वागत है. वेलकम टू दिस फेस टू फेस एंड दिस टाइम इज फेस टू फेस ग्लोबल. Friends, face to face has been a very important part of my life. And every time I think of discontinuing the same, I realize that I cannot because there is still so much to learn from face to face. This probably will be 240th face to face. And every face to face is like a gold mine for people who are serious learners. Friends, US Championship is a reputed championship. And there are many great talent in global markets who have done phenomenally well after they have won the US Championship. We have case in point Mr. Mark Minervini, whose face-to-face I recorded as well. This video is also with a US Championship top performer, and you'll be amazed to learn from him, his strategy, his style. And I was really excited when I was recording this because his style is quite similar to what I practice in India. At times we think that how can two people think alike? So if you like what I do, if you like swing trading, if you like the fact that you want to create long-term wealth by trading in stocks, this is the right face-to-face with you. Guys, do make sure that you follow us in our YouTube channel. Now we are almost 1 million plus subscriber, and we urge you to become part of this family because face-to-face is not just any content. It's a revolution, and I want you to become part of this revolution. This face-to-face will obviously be in English because our learned trader expert is from other part of the world, and his name is Marios. So let's welcome Marios and learn from him as much as possible. Best of luck, best of learnings. Hello, Marios. Welcome to Face Global. Thank you so much.
Hello, Vivek. Thank you so much for having me. It's a pleasure
Thank
to be
you.
here. Let me share my screen.
Sure.
So, is it perfect? Is
Yes,
it
I
showing?
can see your screen.
Yeah, all right. So, as you said, I decided to do a presentation this time. Usually, I prefer the more interactive conversation, but since time is limited, I thought about giving as much condensed information as possible so people can go back and forth, right? And have it all in order. So, the topics I will try to cover today is first of all, my background from 2015 when I started in the markets up until now. There were many struggles and changes of perspective of my approach along the way. So I think it will be valuable for people that are early on their journey to here. Then I will talk about the two layers of trading. This is a term that I use that separates the trader's journey into two parts, the knowledge part and the wisdom part that comes later on. We will also talk about the principles to unlock the first layer. So the principles needed to unlock the knowledge part, which is extremely important. Then we will talk about the setups that I use. We will go into more details about the specific criteria that I use in my methods. I will also talk about my process and routine, how I find the names that I'm trading, what is my preparation daily, and then we can talk about the basic risk management principles, how I enter, how I add, how I manage my positions, the selling rules I have. And then we can see some examples from the US and Indian market as well. And if we have still some time, I will try to touch base on the points regarding the second layer, which is beyond the basic knowledge, right? It's gaining extra wisdom from the knowledge you already have. So let's start. So let's talk about. I want to talk about something that I call the two layers in trading and the two layers in mastering trading. So I didn't have the chance to talk about this in our previous meeting. So let me get more. Let me say more details here. So think of these are the two layers that you need to unlock and understand to achieve a sustainable good performance year over year in the markets. And think of the first layer as your bachelor's degree in the markets, which is more about acquiring the knowledge and putting it in order. And the second layer is kind of like your master's degree or your PhD degree, which is using the knowledge that you already have, but making multi-level connections with it until something profound happens. And this is wisdom, this is intuition, this is some other stuff. So the key here is that most people are stuck in the first layer of knowledge. And I was too for many years. Because when you're starting out, you don't even know that the second layer of knowledge exists. And unlocking that second layer of knowledge requires a lot of effort, thinking outside of the box, deeply researching about the markets, uncovering hidden nuances, and of course, changing your perspective on things you've learned for long. And plus, not a lot of people talk about the second layer of knowledge because most educational materials and courses and interviews focus on the first layer because it's easier to be taught to people and understand, right? So let's start with the first layer, which includes my setups, my general methodology, risk management, what I want to see stocks and I buy. And if we still have some time, hopefully, we can touch base on some points about the second layer, right?
Sure.
So here are the principles, some principles that can help you unlock the first layer. So some of them are technical and some of them are not, but all of them are really important. So the first thing, and I think it's really important, is you need to find and we talked about this, but you need to find a passion for trading beyond just opening and closing trades. And what I mean here is the market will make you feel stupid many times. There are going to be moments where you're going to feel helpless. There are going to be moments that you will want to quit. And this happened to me, as I told you. So you need to have a deep passion to keep going because it's not easy. And where you're starting out, you'll almost certainly get into trouble. Of course, learning from good people and material will help you avoid and skip some of the trouble, but you'll still face challenges, even if you get to the mastery level. This is your tuition fee, right? So for me, the passion came from studying other traders, diving deep into the stock market history, seeing the market as a complex puzzle to solve. Of course, I started this journey to make money, but as I told you, it became an obsession and a puzzle that I wanted to explore and solve. And like I told you before, you might remember it because you seemed interested. I have learned to love the game, right? This kept me going through times because even if I was feeling heartbroken, even if I was feeling helpless, I still like to explore. I still like to do research to find new things, combine dots together to try to come as closer to solve this puzzle, right? So this is the first thing. The second thing is not again technical, but equally important. So it is to maintain a positive mindset along your journey because I consider that an edge. So you should try to block all the sources of negativity around you. So these are mainly news that push stories over and over and can distract you. And all this negativity, as I have said many times in the past, is like radiation. You don't see it, but if you are exposed to negativity for long, it gets to you. So mainstream media is a business, and it's a business driven by clicks, and clicks are driven mostly from negativity. So it's really important to react in what is happening in the markets now, not of what is the sentiment around you. So even if we pull up Nifty and we check some recent historical events like 2008 financial crisis or COVID crisis, right? Every time there is a doom story, and every time the market recovers, and specifically Nifty shows better recovery performance than US markets. So if we check in 2020, and I can pull Nifty real quick, right? So if we check on 2020, right? Of course, we had the sentiment that the world will end, and we had lockdowns and panic. Well, the market recovered in a few months, and we had one of the best rallies in the nearest 10-year history, right?
Yeah.
So imagine this period right here. Right here, there was a lot of panic. There was a lot of panic, but the market recovered. So you really need to focus on what is happening now. And of course, we had the same thing with Russia and Ukraine. We had the same thing, recently with Israel and Iran. So it's really important to focus on the now, not on the sentiment, because basically forget about the macro things and try to be surrounded with positivity and check the now, because no one knows the future. Even the CEOs of the high-end companies don't know how the world will look in 5 years, right? Because there's always a surprise, there's always a new event, a disruption, like we had with artificial intelligence a year ago. So many changes because of that, right? So this is the reason many of us choose to be traders, because it's easier to take advantage of something that is happening now or 2 steps ahead rather than something that happens 15 or 20 steps ahead, right? It's hard to foresee that. So now getting into more technical, which is the third point, and it's also the continuation of the previous, it's you need to focus on what is happening in the price action right now and not on stories. So to effectively deliver my message, at least this is how I philosophically see the markets. And I have written an article about this in the past. So in the markets, every idea, every rumor, every news, every agreement, every possible announcement, every analyst recommendation, every estimate, every action, everything has only one way of expression. If you approach this concept really deterministically, everything has only one way of expression, and that is price. So there's no other way of things expressing themselves rather than price, right? So I kind of see the price as containing the collective wisdom of the overall mechanisms of the market, of course, right? So containing both evident and hidden variables. And what's the key here is by developing ways to study price action, you get a chance to look into the collective and gain clues beforehand. So many times, the price is going to signal you in advance of some events before they happen. And this happens both before entering on a stock and both on selling a stock. And let me give you an example to deliver this point effectively, Vivek. So I will just use the US market for this specific example. But check back in 2020 how the S&P, which is the primary index of the US stock market, looked like, right? So let me go around here. Let's go up until the day. So this is 21st of February 2022, all right? And let me put up another stock, which is APT. Again, at the same period, which is before the 21st. Let me see if it's correct. So it's here, before the 21st of February. So if you look at the markets, or if you look at the index, there's nothing, strange in it. It doesn't look strange. It's just on a move up, right? It shows linearity. But here's what happened, right? If you do a research on stocks, you see a stock that is showing an extreme relative strength, right? Showing extreme volume, right? And it's building a flag. So if you did a research on this stock, this specific stock, which should pop into your scanners, it should pop into your process, right? You would see that this stock was making protective masks back in the 2020 COVID crisis, right? So as you can see, before the full lockdown and all the things happened, this stock was showing an extreme relative strength. All right. So just check what happened after the market has dropped significantly, right?
How did you measure the relative strength? Do you use any tool, indicator, or
I will get specifically about this in a bit.
Okay.
But what I wanted to deliver here is that the price action foretells a probability of a story before this story unfolds. So this stock was showing strength before the market has crashed. And this stock went from $5 into $40 in less than a week.
Wow.
So you can see how the inner mechanisms work. The price seems to be the collective, and sometimes the collective leaves clues for the probability of some events that are going to follow that no one accurately knows beforehand. So that is a big edge in my point of view for unlocking this first layer. Focus on price and not on stories or rumors or macro views. And just to give another quick example, if we check another great stock back in 2020, which is the Zoom, the platform that we're having the call right now, right? If you see the earnings and sales of this stock were amazing back in 2020.
Yeah.
Moving forward, you can see triple digit returns, 900% return, 900% return, 700% percentage, sorry, not return. So you can see that the fundamentals are way good at this point of time, but the price is taking a hit, right? So it was after the price have moved down 80 or 90%, and then the bad fundamentals came. So price sometimes foretells a story that's about to happen or foretells the probability of a story. This is the collective. This is, a main edge for us.
Yep.
All right. So let me be more quick now. So the other thing is find people who have had great accomplishment and study their methods extensively.
Right.
So you don't need to reinvent the wheel. Advancements in trading and general knowledge is like science. It gets better, it gets more broad and chaotic over time. So you don't need to find all the clues on your own, right? You can find some people that have done some great accomplishments, study their method obsessively, right? And you can skip a lot of trial and error. And the key is lending parts from other people's work and adjusting them to fit your style and personality. This is key. The other thing is to develop a foundation of setups that have worked historically for many decades and are still relevant and evident. So what I mean by that is you can't trade randomly. You need to understand why certain setups appear, verify their evidence and occurrence over time, right? So even if you look at commodity markets in 2 centuries ago, or the stock market 40 years, 30, 20 years ago, these formations, the classic formations that basically momentum traders use, appear again and again, right? Because this is the expression of supply and demand. And we'll get about specifics in a bit, right? So there needs to be a balance between occurrence and evidence in past data with the foundation and the setups that you use. And also you need to develop solid entry and position sizing and selling tactics, and all these need to be fine-tuned. And the last thing is to create a robust routine and process to track the best momentum leaders day in and day out. This is key because trading is like a sport. If you go into a match and you haven't trained properly or studied your opponent, you are going to feel anxious. You will feel more vulnerable emotionally. And the same applies with trading. You need to have a robust routine and process to track the momentum leaders, to know what's moving, what's not. You need to do your homework because when you do your homework, as I have said before, is how you find these hidden clues and the probability of future events. Now, I don't mean spending 20 hours per day, of course, in front of your screens, but depending on your style, you really need to have a method to prepare yourself, and this should be done efficiently. And I'll get about how I do it, right? So,
lovely.
This is the principles. Yeah.
I think that first slide was something, Marios. It was such a lovely slide. In fact, I have taken a screenshot of that slide. I'm going to take a printout and put it in front of my desk. This is one slide. What you have given is, in India, we have this Gita Gyan where, Lord Krishna, he narrated a lot of things to Arjuna during the Mahabharata war, the big war in India.
Yeah.
I don't know whether you know about Gita. Huh?
I have written some text about Mahabharata and Ramayana, to be honest, but it's a long time ago. Yeah, I
Yeah.
find it great text. Yeah,
So what you have given is actually a Gita Gyan to us. That is amazing slide, and I'll take your permission to post that slide on Twitter right now after the completion of our video, so that
my
people get
pleasure,
the
my
knowledge
pleasure.
immediately.
I'm trying to be quick because there's a lot of material, and I'm trying to be as quick as possible. But thank you
Yeah.
for it. So let's get into the setups and more exciting stuff. So
Yeah.
as I said before, this is the two setups that I use, right? And I get into the only the long setups
Mm-hmm.
because these provide the most benefit in my style. I also use some short setups, but I won't cover them here.
Yeah.
Uh, so the first setup I use is the breakouts.
Okay.
If you check of decades of stock market data and specifically the best performing stocks, you will see commonalities. So stocks tend to move with legs up, followed by tightness, then new legs up, followed by tightness, sideways move, right? And
Yep.
so on. So, yeah, what I'm tracking is to be close to the moment the stock moves from this tight range with the probability of continuing up, right? Kind of the same concept like Mark Minervini VCP pattern or cup and handle pattern, but with some variation. So the key here is I don't try to take breakouts randomly. I'm tracking the momentum leaders that are showing extreme relative strength, that print big volume, that are getting tight into the right side. I
Mm-hmm.
also employ some moving average on the daily chart, like the 10 and 20 moving average.
Mm-hmm.
And I try to track where the supply zone is, because this is the zone that the stock needs to surpass, right? From
Mm-hmm.
moving it to higher ground. So I put an alert above this zone where the price is forming, and I
Mm-hmm.
try to take trades on the breakout day. So we'll get about this in a moment. The second setup that I trade is this one, which I call the catalyst gappers. Uh,
Mm-hmm.
so this is a setup I really, really like because
Mm-hmm.
it can't easily have an edge erosion. And what I mean by that is that the breakouts, like that we talked, is a concept that have been massively used for decades.
Mm-hmm.
So there is an edge erosion, a slight edge erosion. Not that they are not evident or they don't work, because if they weren't, I wouldn't trade them, right? But edge erosion means that the win rate or the probability of a good outcome has dropped a little going through the decades, right? So on this specific setup, the catalyst gappers, even though if all the people around the world
Mm-hmm.
learn this setup, it won't even matter because it is based on surprise events. And surprise means something unexpected, means big volume, means a lot of participation, means amplified emotions,
Mm-hmm.
means greed and fear, right? So the stock might have been moving kind of sloppy or sideways for a long time,
Mm-hmm.
and then a gap occurs. And these gaps happen because of a big catalyst, or
Mm-hmm.
to say it simply, because of an important news event regarding a company or a sector or industry, right?
Mm-hmm.
So there are many different reasons. It can be um, a new policy of the overall industry. It can be an acquisition announcement. It can be
Mm-hmm.
an analyst upgrade.
Mm-hmm.
It can be, if it's a pharmaceutical or a biotechnology company, it could be a clinic trial or approval from a government agency. In US, it's the FDA. In India, it's, I don't know, it's the CDSCO or something like that, right?
Frankly speaking, we hear so much about FDA in India also that we don't
Oh, okay.
know who is there in India.
Yeah. Yeah, so it could be because of that, or it could be an announcement of a new product or a service, right? But mostly it happens because of earnings announcement every quarter. So just to sum it up, the reason I like this setup is, as I said, surprises gets everyone off guard, and that is the meaning of surprise. No one can easily see it coming, right?
Yep.
And this is important for the following reason, because most of the market participants, either individuals or in the form of funds, are not exactly trading but investing, right?
Yep.
So classic investing is not based on price action but on valuation models
Yeah.
that track many fundamentals metrics like cash flows, EBITDA, depending if they do discounted cash flows and all that stuff,
Yeah.
right? So what a big surprise does to these models, a big difference, a big surprise of the consensus overnight changes dramatically these valuation models. So a stock could be considered overpriced before the news. Maybe at $50 it was overpriced, and the next day overnight it might be undervalued or underpriced
Yeah.
at $70 or $80, right?
Yeah.
So this
Yeah.
change creates a lot of volume, a lot of competition, and always surprises always amplifies emotions. So both greed and fear. So I really like the setup because it's a combo of massive participation in the stock market and in the stock itself. It has also been studied academically a lot, like as post earnings announcement briefs, and it also has a deeper fundamental factor in it, right? So let's get into more details.
Hey, Marius, I was just thinking this presentation looks very impressive. So, will it be okay for you to share this PPT also with us so that we can share it with our audience?
Yeah, of course, of course. It will be a pleasure of mine.
Wow,
Take it,
lovely.
use
Thank
it,
you.
of course.
Thank you so much.
Um,
As they say that you give, if you give more, you get more. So I believe you also believe in this theory so much that you're ready to give more to every one of us. Thank you.
yeah. I believe in it quite strongly. All right, so let's get into more details now about the breakouts, right? So here are some things that I look for before taking the breakouts. So the first thing is I only focus on momentum leaders. And
Mm-hmm.
momentum leaders is always a small fraction or percentage of the overall universe of stocks, right? So
Mm-hmm.
you need to have the tools to track those stocks because these are the stocks that have been supercharged and blessed by the current market. So momentum leaders can be commodities names as well, like steel or copper or wheat or gold. It depends on the cycles and events, right?
Yeah.
So I always focus on momentum leaders. The second thing is I follow stocks that show big relative strength compared to the index. And what is relative strength? And I'm sure you know it because you love it. It's a
Yeah.
metric that is hugely important that we use to find the most powerful names in the market, right? And
Mm-hmm.
this is something that separates momentum traders from other participants in the market because we don't look at the markets as discount stores like many people see them.
Yeah.
A
Yeah.
stock drops 50%, let's go buy it, right? And then it continues to fall. So the stock market is not meant to be a discount store. And I think us as momentum traders and swing traders are doing a good job not seeing the market this way because the best vehicles are always going to seem more expensive.
Yeah.
The same thing that you can't buy an Aston Martin, let's say, in the price of a Nissan, right? The same goes with the stock market. The best
Yeah.
stocks that are meant for power and speed are most of the time going to look expensive.
Yeah.
So the reason that I mentioned here, it's important, especially in bear trends, is because you can easily see the stocks that are picking up in price compared to the index in bearish conditions. So in deeper corrections of the markets, some of the stocks that are showing extreme relative strength get to be the next leaders in the upcoming cycles after the correction ends.
Yeah.
So this is where you should be. So please, Vivek, when we get to the examples, please remind me to show you one or two examples about stocks that were showing really big relative strength on corrections, right?
Okay.
The third thing is tightness development with higher lows. So tightness is an expression of supply and demand. You need to be patient in tightness so that the liquidity kind of drains. So if the liquidity has kind of drained enough, the biggest the chance the stock is going to move on a higher ground without a big effort. So
Yeah.
it's also useful to see higher lows to be evident because this shows signs that demand is still there visually, right? Um, Another thing is the volume picking up compared to the past. So this is really important as well because we don't move the market. Funds and institutions move it, right? 80 or 90%.
Mm-hmm.
So a big volume footprint, sorry, can give you some clues about the actions and the footprints of the major participants, like these funds, right? So if you see these footprints, it can make the outcome of the setup a bit more probable, right, in terms of the win rate. Another thing is volume slowing down during tightness. So when the chart is moving sideways and it's getting tighter, you want to see the volume drying up, right? And this has to do a lot with the 0.3, the number 3 that we talked about. The other thing is I use the 10 and 20 simple moving average to kind of smooth out the trend. And I always, when I'm taking breakouts, I'm 99% of the times I always wait for one of the two moving averages to catch up, and I use them as a rail before the stock moves higher, right?
Okay.
So you can see it on the example right here. You can see that the red line is the 10 moving average. I waited, and this is an Indian stock, right? You see that the stock moved up after it had met the 10 moving average, and then again with the 10 and 20. So I kind of use them as rails to kind of be more patient about, the tightness. The other thing is something that I call, it's not, I call it's termed the ADR. So this is the average daily range. And it's a metric that tells you on average what is the percentage the stock moves up or down in a day.
Okay.
So ADR above 2.5%, it means that a stock moves around 2.5% up or down in a single day, right? On average. So stocks are different. You might have a stock that moves, let's say, 20% up in 2 months, right? And another stock moves 20% in 5 days.
Mm-hmm.
So ADR is a good metric to have because it separates the stocks into categories: faster stocks and slower moving stocks. Okay. So I always use this metric because I want to have my portfolio in more fast mover names, right? Moving names. Okay. Because time is really important. Time is, as traders, is our most valuable assets. You need to be in the right vehicles so you can eventually compound more efficiently your money. So you need to be in faster names. Okay. And now we're getting into some other criteria that are not so strict. I use them as bonuses, right? And if a lot of them are combined together, I have a textbook or a powerful setup. Okay. So the first bonus is the stock name that I'm tracking to be held by the general theme. And that's important because when you have stocks that are supported with the current trends and still fulfill the previous criteria, it gives you more conviction. So, for example, we had, as I told you before, the artificial intelligence stocks as the artificial intelligence trend, right? So stocks, at least in the US market, that were in the artificial intelligence and they were making press releases about the artificial intelligence, they were helped. They had more fuel in them, right? Okay. The other thing is acceleration of earnings. So as you see, this is one of the main differences I have from Kansley or Mark Minervini, because I count the acceleration of fundamentals not as a strict criteria, but as a bonus. And the reason for this is because I have done extensive research in the markets and I saw many stocks moving 200, 300, 400% up or more based on stories, based on hype, right? And not on fundamental numbers. So in some cases, there are many stocks that had negative or no numbers at all and made great moves. So if you limit your universe based on your scanners only on stocks that have profound fundamentals, right, you exclude yourself from really powerful moves. And if I had not cut these moves, where I can show you some examples when we get to them, if I had not cut these moves in 2023, I wouldn't have made these returns that I have made. And also this year, I was able to catch some names that had no major fundamentals, but they had a great story or they had a hype or a big theme along with them, right? So this is a bonus for me. If there is acceleration of sales, perfect. It's a bonus, but it's not a strict criteria for me. The other thing is acceleration of sales. So sales are more important than earnings. Why? Because earnings per share or earnings can be manipulated. Sales cannot be manipulated. For example, a company can fire employees, cut expenses, right? And show really big earnings for a period, even if the sales are the same or even if they have dropped a little. But if a company does not drive sales, then the growth stops at some point because you can't cut costs forever, right? So sales is much more important for me because they can't be manipulated and they show growth. The other thing is triple digit results, right? So if you have triple digit results, it means that the company that you're tracking has doubled or even more in a single year. So that's a remarkable milestone. That's a remarkable feat. That's a big fuel, right? And just to sum it up, I also want to see big analyst estimates for the next years and also a good linearity of past price action. This is also something I use as a bonus. The more clear the charts, sorry, yeah.
No, I'm okay. You just complete. I have 2-3 questions, so I just
Of course. So just to end this up, the more clean the price action looks on the left side before the tightness, the better chance. So if it doesn't look choppy, the better chance that the breakout is not gonna give you so many fakes compared to another name, right? Yeah. So please ask me.
So when we talk about acceleration, is there any number you have in mind that this defines the acceleration? Number two,
No,
when we talk about two-part question. When we talk about earnings, sales, or results, is it a quarterly result you're talking or the annual result?
All right. So I'm talking about quarter results that are for year over year, right? So I'm tracking quarter per quarter. And when I mean acceleration is the how in the progress of earnings showing up, I want to see these earnings or sales get slightly higher. So I have an example on the next slide. So maybe people, the people that are looking at this will understand it better.
Sure.
Yeah. So what I wanted to say also is I use the different variations of these setups. Sometimes it's on leading names, and sometimes it's on beaten down names that haven't done something remarkable, but they show some strength, and maybe they can create a new theme. So, just a quick example: on a couple of weeks ago, I took a trade on a hot theme in the U.S. market, which is around cannabis name. So I was able to catch this ACB trade right here, right? So this stock is not above the 200 moving average. It's not, showing great fundamentals. If I excluded myself sale, I've cut this move, which was, 100% move in a small amount of time. So I have different variations, as you understand, right? All right. So let me show you this example because you'll understand it even further. So I decided to put NVIDIA as an example to explain those points, right?
Yep.
So if we go to the one by one, the criteria, right? So this was a momentum leader. NVIDIA was one of the leaders. It is still now one of the leaders in the US stock markets. And regarding, right? So first criteria check. It was showing big relative strength compared to the index, right? On this formation right here, if I pull up the S&P at the same period, which the period was this one right here, you can see that S&P is downtrending, right? A lot, but NVIDIA is showing strength. It's not downtrending, right? It's moving sideways. So we have relative strength as well. We have tightness, right, on the right side. And getting tighter and tighter. Perfect. Also, during this tightness zone, the volume kind of, drops. It has a progressive tendency to lower, right? The ADR of the stock was more than 2.5% at this point, or around this percentage. Also, you can see here the numbers, right? So you can see an acceleration of earnings from negative numbers, right? It went to positive numbers and triple-digit numbers, both on earnings and both on sales, right? This is acceleration. This is the acceleration that I'm talking about, right?
Yeah.
Really, a momentum in the growth of these metrics. Also, this stock was helped by the general theme. We had the artificial intelligence. This stock was leading the artificial intelligence hype, right? So we had triple-digit returns. We had linearity of past price action.
Mhm.
Everything was in tune, right? So this is a
Mhm.
perfect example. So was a tight point. This was a perfect entry right here that I took, right? And the stock went from 500 into nearly 1,000 with not much of a break, right? So the key here is try to combine all these clues and to stack up all these points until you can discover, the textbook setups or setups that look better than other things you look in the market. Okay, so
Hmm.
is it good so far? Do you have any questions?
No, no, it's absolutely. And while you are explaining me on my other laptop, I am playing with TradingView and NVIDIA chart and trying to relate what we are discussing with the real chart. So it's perfectly clear.
All right, perfect. Okay, so I'm pretty anxious that we won't be able to cover it all in 1 hour and so interview. So I'll try to be quicker.
No, no, please
Uh,
don't be quick. Please don't be quick.
okay,
Let's take our time. Let's not leave it in the middle. Please
okay,
allow me some more time so that we complete our discussion today. Please don't
okay,
keep it
okay.
short.
Okay. All right. So just I won't go over many details here. So on the catalyst gappers, I try to track an announcement, mostly earnings announcement, right? I try to check for stocks that are gapping up more than 5 or 6%, at least for US stocks.
Yeah.
Uh, I want to see big pre-market volume because it shows extreme participation. I want to see big earnings surprise because surprise means unexpected, right? An
Yeah.
unexpected bit of estimates. Also, the bonuses are I want to see the stock have a neglect for a long period. And this is
Yeah.
important because this gives clues that indeed this event was a surprise and
Yeah.
there was not a big rumor or insider knowledge of some sort. Neglect means that the stock wasn't moving extremely hard for many months prior to the move, prior to the
Hmm.
gap.
Hmm.
Uh, Also, the guidance raise. This is important. If the company itself says, have great announcements in the future, this is a guidance raise. This is way more important than ensures fuel into action. Also, if we, as I talked before, if it's in a hot theme, it's better. Also, if the gap up escapes from a multi-week or multi-month tightness range, even better. If we have big estimates for the next year, this is big also, it's important. Also, if you have triple-digit earnings or sales is equally important. And lastly, if um, it's earlier in the bull cycle, the better, because I might get more conservative when we get later into the momentum cycles. I try to be, I try to be early on these setups. I don't want to have a stock that moves up for a year, for example, really strong, and then gaps up, because from studying the markets, I saw that on this setup, the earlier, the better, right? Because as you get later into the cycle, the likelihood of this working out drops a little, all right?
Hmm.
So this is an example to show you kind of the earnings and sales. So remember, I talked about uh, big estimates for the next years, right? Big analyst estimates for the next year. So this is a stock which is called Uplovin, and it's in artificial intelligence. Check on this table right here. You can see for 2021 and 22, right, the earnings per share were 0.07 and 0.18. And
Hmm.
then you can see a big change to one. This is an extreme change, right, on results year over year,
Hmm.
right? And check the estimates for the 2024. Again, it's a big difference from the previous, right? So this is a fuel. This is what I call the fuel, right?
Hmm.
All right. Okay, let's get into the next slide real quick. So this is how my screen kind of looks like, right? So don't get trouble. I will explain everything. So it's really simple, honestly. What I have is I have some moving averages, right?
Okay.
Um, I track the 10, 20, 50, 100, 150, 20, 200 moving average. The main are the 10, 20, so the red, yellow line, and also the 50, right? I track all of them, but I told you that 10 and 20 are the most relevant to me, right? So this is the first thing. The second thing I have right here is the next earnings. I want to know when the next earnings of this, when this company is going to announce earnings, right? The date. This is right here.
How do you next earning? How do you insert this?
This is a charting platform which is called the TC2000 that I use mainly. So I don't know if it's on TradingView or something, but I'm just explaining my layout.
Sure.
Yeah. The other thing that I told you is the average daily range and the average true range right here. So I want to see if the stock, is quick, fast mover or not, real quick. And the ATR is the amount of dollars on average the stock moves in a day.
Yeah.
Okay. Something different also is I overlay the news on the chart. As you can see, I have the relevant news of the company overlaid in my chart. Because when I open a chart, I want to see quickly the story, right? I also have a summary, okay, because I want to know also the news and what this company does. What do they develop? Is it in a theme? What's the industry? What's the sector? And also add some helpful notes. And I also have the volume with some pocket pivots. This this white bars are showing volume that shows relative strength as well, and the dollar volume, which is the volume multiplied by price. And the reason for that is because many times stocks split and they might show a big volume, but the money that is moving might not be the same. So I always like to have the dollar volume as well. Okay. So that is covered. So we can get a little bit quickly about my process and routine, right? How I find these names, how I scan for them. Okay, so let me open my charting platform. So what I have here is, this is my pre-market screen. Sorry, not this. Here, the swing scans. All right. So what I do is, these are the main scans. So what I do here really simply, and I can show you my criteria, is I scan for stocks that show. Let me rephrase it. I'm scanning for the top 8 to 10% of stocks of the universe that have good relative strength compared to the index in the 1 month, 3 month, and 6 month period, right? Okay. So I go every day, I go through all this list every day. So I might have to close the pre-market. So usually it's 100 names in each list or 200. I go through all of these names, right? And every ticker that I like, I copy it to a different main watch list, right? Okay. So I'll go through all of them, these scans every day, and whatever ticker I like, meaning that I find a ticker that's showing relative strength, it has moved up quite a lot, maybe it's getting tighter, I will just copy it to a main watch list, all right? Okay. The other scan that I have is this dense volume. So I'm scanning for stocks that show extreme volume in the past month or so, right? And I do this because this is how I quickly find stocks that have not yet, maybe they don't have good fundamentals or earnings, or haven't made a big leg up, but because they have they have a footprint of volume, maybe they will emerge into big themes, right? Exactly like I told you with this cannabis name ACB right here. This stock popped into my scans, right? Into this dense volume. So whatever stock I like from this scan as well, I put it in a big watch list. Okay. So the next step is, after I compile this big watch list that I put stocks every day in it, every day I will go through all of them, right? Okay. And if a stock appears that is getting tighter and it's ready to break out, right, I will just draw a trend line. Let's show NVIDIA right here, right? Let's say this popped in my scans. I would just draw a trend line and then I would put an alert on it, right? Okay. So all the stocks that I have are there with alerts, are there with trend lines that show the tight points, and I also have the best stocks that are moving right now in the market. So when I get an alert, of course, I will this stock will pop into my screen and I will trade it. And also when I from this bulk list, this big watch list that I create, every day I create another watch list, which for the names that I'm track, I focus today, it might be 4 names, 5 names, 6 names, right? So on those names, I try to be more, I try to check the news, I try to check the fundamentals, I try to check the stories, the news, everything, right? Have all the clues. Okay. So I can talk a lot more about my routine. I do other things, but let's not get to them right now. For example, I check the sectors, industries in 1 month, week, 1 month, 3 month period. I want to see what's moving, what's the connections between the industries. But let's save some time to move forward. All right. I think I quickly covered what I do with the breakouts, right?
Yep,
Okay.
absolutely.
If you have any questions, let me know, Vivek.
No, I think it's crystal clear. And I mean, I'm very happy, very glad to see your setup because it's so much similar to what I do. So
Yeah.
it's pretty much absolutely clear. So we can go to the next setup.
All right. Perfect. So these are the basic principles for my risk management, right?
Mm.
So I calculate my shares based on entry minus stop loss distance. I'm
Mhm.
not using a default percentage stop. I don't know. How do you calculate your shares? Do you use a specific percentage stop? Do you say, or do you calculate your shares based on entry minus stop?
There are both the methods. I look at, I mean, I have a fixed value which I want to invest in a stock,
Mm-hmm.
and I build on to that value. Not that from day one I will invest in that value. So for
Mm-hmm.
me, distance of stop loss is not very important because I know on an average what is the percentage of stop loss which I typically get in my stocks.
Great, great. So
Mm.
uh, I use a different method from this approach, and only because what I do basically adjust for volatility. So if you calculate the entry minus the stop loss distance, and you have a fast moving name, right? It will be a bigger distance in terms of dollars. If you
Mm.
have a slower moving name, it will be a smaller distance. So if you calculate your shares based on this method, basically it auto adjusts for the volatility of a stock. So you're going to end up with kind of the same position size either at the fast moving name or at the slow moving name, right? So
Yeah.
it's just different variation. It's not something crazy. Oops, sorry. Something dropped my desk. So the other thing is I try to limit my positions to 25% max of my entire portfolio
Okay.
and a smaller percentage for biotech companies. So the reason I do that is you don't want to be overexposed to a specific name because everything is random in some sort in the markets. I mean, the CEO could die in the next day and the drop could
Yeah.
drop 20%. So you always need to protect yourself of the unexpected events. Our job is to be risk managers, not the best stock pickers. My risk per trade also is 0.2 to 0.3 of percent of my account.
Okay.
So that's kind of a small risk, but I find it useful because my win rate is also small. I also use progressive exposure to get into positions when I'm back in cash. So I won't, go when I'm back in cash from a bad period or a corrective period. I won't open 5 positions at the same time. I will slowly open 1 or 2 with smaller risk, and then I will let, the profits or this buffer finance my next trade. So on the best period, like Mark Minervini, I learned this method from Mark Minervini, right?
Yeah.
On the best periods, you trade your max size. On the worst periods, you trade the smaller size.
Yeah.
And also, I rarely use margin, right? So I
Okay.
don't go overly on margin, and I have a lot of rules that I can't get into detail now, but for not getting into margin. But basically, I check to have a lot of risk-free trades, to have a lot of optimal positions before getting into margin. Now, it's not that I'm 60% exposed into the margin and I will go to 150 exposed, right?
Yeah.
First, I will get to 100% exposure close to it. I will check many criteria. If everything is perfect, then I will open some margin.
Yeah.
Okay, so my win rate is around 25 to 35% depending on the period. I always look for 4 to 5 hours on average return on a trade. And on big wins, I might get 30, 40, 50, 60% are multiples because my stops are really tight. So I sacrifice a lot of win rate for the potential to make an asymmetric return in terms of risk to reward ratio, right?
Yeah.
Okay. So these are the basic principles for my entries. So I enter on breakouts only when the price moves above a pivot, when I get an alert.
Okay.
Or I may enter on anticipation with a 5-minute orb, right? My stop loss is at the low of the breakout day most of the time. So I'm not using the classic, let's say VCP, which is the pivot. You put your stop at the pivot. I put it more tightly and usually at the low of the breakout day, right? So this is a really tight stop. I try to, a metric that I use to have tight stops is the ATR. So my risk, so the entry minus the stop loss distance, I need to be smaller than 1 ATR. So remember, ATR is the average true range. The dollars a stock moves on average every day. So my stop, my risk, I need to be below 1 ATR. So that means that on average, every day I'm going to get at least 1 R if the stock moves in my side, right? So this ensures tightness.
What is ORB? Sorry to ask you this.
Oh, all right. So ORB is opening range breakout. So it's a formation. The stock may open, let's say, at $50. It might move a little sideways or drop. And on the 5-minute chart, if it breaks the opening range, the open price, this is an orb, right? Or maybe the highs of the first candle. If you look at the 1-minute chart.
Okay.
All right. So the other thing is I won't enter on a stock if I don't have a position already. I won't enter if it's close to an earnings announcement, right? Because this is gambling. If you enter on a stock 3 or 2 or 1 day before the earnings, no one knows what's going to happen. Yeah. So it's kind of gambling, right? So I always avoid stocks that are close to earnings. I may hold the position that I have for long into earnings if I have built it for a long time ago and I'm in profit, right? Right. On catalyst gappers, I enter again on opening range breakout on 1 or 5 minutes. I put my stops at the low of day. And if the low of the day is violated, I might try again when it reclaims the VWAP. So VWAP is another indicator that I use, right? Which is important for me because when the stock moves, maybe it has violated the lows. When it gets back to VWAP, for me is a sign of strength, and I might enter again there. And the other thing is, if a stock on the daily closes red or weak on the first day, I will preferably wait for a sideways action. I will wait for a moving average to catch up like the 10 moving average, and then it converts into a hybrid version of a catalyst gapper and a breakout. So something, just to give you a visual example, something like a SOUN from the US stock market. Do you see that here it had, a news announcement, right? But it didn't do much. And then it moved kind of sideways. And this was a breakout day moving from the 10 moving average, right? So this is a hybrid of a catalyst gapper that didn't work right away with a breakout that happens a little bit later, okay?
When do we enter here on the breakout day?
I entered on this day right here. So I waited for this tight range. I waited for the 10 moving average to kind of catch up. So when it moved above this range, I entered with a stop below this price right here, right? Okay.
Did you get chance to enter? Because by the time your alert will come and you will log in and you will enter, the stock may have moved, no?
Yeah, sometimes I miss some opportunities, to be honest, right? So if it's more than 1 ATR, I might miss it. But because I have a really strict process, 80% of the times, the stocks that are probably of breaking out are going to be in my focus list beforehand. So SOUN was in my focused list that I was tracking before hearing the alert, right? So as I told you in the slide, sometimes I enter on anticipation, as you see, on the breakouts. I may get an alert on a pivot, but I might enter on anticipation, right? Before this alert happens, because I might have the stock on my focus list.
Okay. Got your point.
Okay, the other thing is basic principles of adding, right? I will add even other setup forms on the daily that fulfills my criteria. So I won't add randomly on a chart. I will enter on a setup, right? And if the stock moves up, right, and it gives me some buffer, and then creates another setup, only if it creates another setup that is valid, then I will enter again. I will add. All right. I will explain all this with a few examples from the Indian stock market, because I won't be able to also explain the US stock market as well, right? So just be patient a little bit. So, okay, so the new stop, I always do free roll ads, right? So when I add to a stock, I always want to have my new stop above my new average price. So when I add, I'm not risking any more money. I will explain that. Okay. Okay, so overall, my positions, even after add, I try to limit them above 25%. But if I have a lot of room, I might go to 30 or 40% on the ad, because if I can hedge it against, if my average is against a 10% decline. So let's say my new average price, even if the stock next day gaps down 7%, I'm still in profit. I can go to 30 or 40% position size. I don't have the initial fear, right? Okay, let's get quickly into the basic principles of selling. So I will sell some shares into strength always, and I will leave some shares for weakness, right? Because this makes randomness an ally in your trading, right? Because when you enter, you don't know what's going to happen. So you got to have this randomness, and this you have to have this randomness as a bonus affecting you, not an effect that limits your profits, let's say, right? So always leave some shares for the weakness. I take a partial 1/5 or 1/4 off after 2.5 to 3 ADR multiples. So if a stock has a 5% ADR, which means it moves every day kind of 5%, right? I will just take a partial if it moves 15% from my entry, right? So this method that I use adjusts for volatility. If a stock is slow mover and has 2% ADR, I'm going to take a partial at 6%. If a stock is a really fast mover and it has 20% ADR, I'm going to take a partial at 50% move up or 60, right? So this adjusts for volatility. I don't use a default. The stock moves 20% up, I take a partial, because every stock is different dynamics. All right. So if the stock is about to close below my entry on the first day or less than half-hour distance, I might close my position on the first day, because I never hold any red positions. I never hold any red positions overnight. All my positions are green. Okay, so I might lose some stocks, right? Because many stocks go below your entry and then they move up in the next days. But just seeing your portfolio always at green gives you a good psychological benefit. Every position is green on my portfolio. At least, the positions that I hold. If I open a new position today, of course, it might be red until, it might stop me out or move higher. All right, so this is a good also method that I use just for psychological effect also. All right, so after the first partial, I usually move my stop at entry price at break even, and I split my shares into two parts. Some of the times, first part I move it at break even, or second part I leave it at the original stop, or at sometimes I might move all the remaining shares at break even, so I have a risk-free trade. Okay. So after I take the first partial, I will trail the 10 moving average. If the stock closes below the 10 moving average, I will take another 1/3 off. And if this happens, then I will track the 20 moving average, right? And if the stock closes below the 20 moving average, I will maybe take all my position off. Or if I have a big cash on, I may wait for the 50 moving average. But this happens more rarely. All right. So I think I try to condense all my knowledge.
If we take live examples, we'll be able to understand it better.
That's what I'm trying to do now. So let's I won't have the time for US stocks, so let's just go to the Indian names. So one example that I found is this one.
Voltam. Okay.
Let me fix the chart. All right. So let's get into, I think it was May 2023, right? Okay. So here. So this is, as you can see, both a catalyst gapper, right? So this day right here, I maybe had the news event, right? On this day right here, right? It moves, it has a gap up, right? And then it converted to a breakout, as you can see right here, right? So it moved up, it got tight, and then it broke out of this range, and then out of this range. And this stock has made, a big move from 3,000 to nearly 6,000 in a small amount of time. So, 1, 2, 3, 4 months, right? So, maybe on 25th of the month, right, which was it's the catalyst gapper day, it had a great report. Maybe, it had an extreme surprise in something, for example, revenues or extreme cash flows. And what does a great report does? It changes the valuation. So a probable entry would be here on this day right here, right? So let's say you went on this stock on 3,600. I would put my stop at 3,500, right? Is it clear?
Okay. Yep.
Okay. So then what I would do is I would wait for a stock to make a 3 multiple ADR move. So if the stock, had, let's say, I don't know if it's clear, let's say it had the 3% ADR. If the stock moved 10%, I would take a partial off, right? So maybe I would take a partial off around here or something. Okay. And then I would wait for the 10 and 20 moving average to I would move my stop to break even. Okay. When I took the first partial, so I have a risk-free trade.
Okay.
And then I would trail the 10 and 20 moving average. So I would take another partial when the stock closed below here.
Yeah.
And then maybe I would take the remaining shares off right here. And then, as you can see, it got tight. So I would probably enter around here or around here. I would put my stop around here if I entered on this candle right here. So this gave another great entry. Of course, on this move, if it's 3 multiples ADR, I would take a partial. And then I will track the 10 and 20 day. And this didn't violate any of these rules up until this point. So I would enter maybe here or here, and maybe possibly add here, maybe not because this candle is big, but it gives an exit right here. So you could enter at 4,000, and without violating any rules, with some partials, you could exit at 5,400. So this is a great trade, right?
Marios, just one question I have in this.
Yeah.
So once you enter based on your second setup, you re-enter when the new opportunity comes, because the new opportunity may not come from your second setup, because your second setup is gap up, gap down. So new opportunity may come as per the first setup, right? Or once a stock has given a gap up, this kind of a structure, then you continue to buy and sell the stock till the whole journey is there, right?
Yes. So if the stock has a gap up, right, and it's a catalyst gap up, and I enter, and then a slightly higher, it creates a tightness in a breakout. This is another setup that I use, right? So I will enter or maybe add again on this setup. If this is what you ask, sorry if I didn't catch.
Yeah. So this is part of your second setup where you exit and then you re-enter if the stock is going above the moving average, correct?
Exactly. Okay. You're right.
Okay.
So another example is this one right here that I found. Again, on April 2023, if you can see right here. So what we see here.
11th of September 23. It was on 11th of September 23.
I'm talking about April right now.
Oh, you're talking about the April setup. Okay.
Yeah.
All right.
So what we have here is look at how big the volume is coming from 2022 into 2023.
Yeah.
Right. So this is a volume footprint. This means interest. This means maybe institutions are entering. All right. So what happens right here is on April, this is a big range that it creates, right? So on April, it kind of escapes that range, right? And it slightly moves sideways, and then 10 moving average is catching up right here. So this is above a long-term range. It moves above it. It moves
Okay.
sideways, and this is 10 moving average used as a rail, right?
Okay.
Okay. Look at the earnings and sales, how they pick up. You get an acceleration. You get the earnings and sales move. Have a momentum as well, right? Look at the volume that follows the breakout after the breakout, right?
Yeah.
Okay. So what I would do is basically maybe I would enter right here, right? So based on my method, maybe I would enter here as let's say at 57, all
Yeah.
right?
Yeah.
And my stop would be at 56, let's say. So let's say we have a $1.5 stop, which is bigger. Let's say we entered here and we have a stop here.
Yeah.
So if you have a $1.5 stop, this stock moved without any violation around $25 in 2 weeks.
Mm.
So that is around 20 times your risk in less than a month.
Yeah.
So let's say you risk 0.3%, right? 0.3% multiplied by 20 times, it's around 6% increase of your account, depending on your sales, of course, right? But do a 6% increase every month compounded, and it results to 100% results a year.
Yeah.
And this comes only for one ticker. So you get where I'm getting at, right? So if I entered here, I would take a partial, maybe right here, then I would move my stop at break even, and then I would track the 10 and 20 moving average. I would enter exit here, and maybe that would exit here. And then I would probably look for a place to add, right? But this gave a fake out, and it didn't work up until later on. Okay. So let me show you another two
So
examples.
how do you, what do you do if suppose you want to enter again and there is a false breakout? Then again, you have a stop loss. Then again, you try to enter. There is a false breakout.
This happens to me a lot. So I get many fake outs because this is the reality of the game. But I always give it another try because my process is based on asymmetric returns. So even if I have 1, 2, 3, 4, 5 losses, one trade alone can account for all these losses and may send me in profit, right?
Okay.
So I always try, even if I get fake outs, because my good trades give me 30, 40, 50 R multiples.
Okay.
So another feature that I found is this. So this thing on 2022 was showing an extreme relative strength over Nifty when I checked it.
Yeah.
All right. So especially in September, right here.
Yeah.
Okay.
Yeah.
So what I want you to see is look how more aggressive this action right here is compared to the past.
Yeah.
It's the stock is more aggressive, right? It has more momentum. Also, the volume footprint that you see here, right here. These are the clues that you need to combine together. So what happened here is this stock, escaped from a so long-term range, moved into higher ground, right? And let's say you have missed this point right here, but here it gave a perfect entry because this is a tightness. Let me just show you the tightness.
Yeah. Yeah.
This is a tight zone, and this is the entry, right? It escapes from this tight zone and see the 20 moving average as a rail. All right. So maybe in October here, you would have entered on a stock, and let's say you entered here, and you have an $8 stop or $10 stop. This stock moved up without violating some things up until, I don't know, 900. So you risk $10 to potentially make $400. So this is 40 times multiple your risk. And also it gave you a chance to add here perfectly, right? So you might have entered here, took a partial off, then waited for the 10 and 20 moving average. Then here it creates another textbook setup. You could add here. So this supercharges your position, and then you apply the same selling rules moving forward, right? And I remember that it had a great move on May 2023 as well. Yeah, right here. So again, the same thing, right? You see how powerful it looks. Tight range, 10 moving average catching up, breakout. Tight range, breakout. You could add here as well if you entered here. It's the same thing all over and all over again. And again, here also gave, let's see, if you, again, it's like 30, 40 hour multiples. So from one trade alone, you could get 30, 40 hour multiples, right? One trade alone, if you manage it correctly, it could make you outperform the index.
Yeah.
Okay, so let's give another concluding maybe example. Check this one now that I found. So this is important because I told you I'm not always searching for stocks that have great fundamentals, because if you do that, you miss great opportunities. So this stock right here, right, was an IPO, of course, and it made the 200 to 300% move up in 2-3 months, right? It went from 180 to 600.
Yeah.
And this is powerful, right? This is extremely powerful, and it had almost no fundamentals. So if you had your primary criteria in fundamentals, you would have never found this stock. So look how strong the price action compared to the past gets in May and June, right? So maybe here it's kind of choppy, you might not be able to enter, but right here is a perfect textbook entry. You have seen the volume footprints, you have seen the strength moving up, right? So here is a perfect entry. 10-day catches up, right? So let's say you entered here at, I don't know, you have a, let's say, I don't know what stop. Let's say you have a $5 stop, right?
Yeah.
Right here. Okay. But let me say something. So this, because it had not fundamentals, it was a great story. I don't know what the Indian market, I'm not an expert here, right? But maybe there was a new government policy. Maybe there was a general trend by the government to expand electrification or infrastructure.
Yeah.
Maybe there was a hot theme or sentiment in India about 5G.
Yeah.
I don't know. This is sea cables, right?
Yeah.
So all these create stories, all these create themes, all these create fuel and explosivity. So if you entered here, that many people would say is late, right? The best stocks that doubled tend to double again. So you had $5 stop right here. This stock moved without violating things $300 more than your entry. So you risk $5 to make 300. Potentially, this is 60R multiples. So it's the same over and over and over again. It's the same thing. So I don't know if we could sum it up here, or if you want me to show you how a pyramid build. So how add on this specific
Just
example.
one question I have. I understood the entry part and the exit part, but how do you add more position on the top, or do you don't?
Okay, so let me show you this example to deliver it perfectly. All right, I think this one is great to show you how I add. The question is how I add, right?
Yeah. Do you add more position so that your exposure in that stock is high?
Yeah. So let me show you how I would treat this maybe, right? Okay, so what I would do, let's say the stock, escapes from a range. We see the volume, we see the move up. It's a strong name. It gets tighter. So let's say I entered right here, right? Okay, so let's take a realistic example and be quick. Let's say someone has $50,000 in the account. All right, and let's say you risk 0.3% of your capital. So that's around $150 around, something like that, right?
Yeah.
So $150 is your default risk. So let's say you entered here at 15.20 and your stop, let's say it's at 14.99, let's say, for example. Okay, let's say you have a $0.2 stop. So if you risk $150 divided by 0.2, it's 750 shares.
Okay.
Okay. So 750 shares multiplied by the price, which is 15, is
11,340.
yeah, around $11,000, which is less than 25% of your overall account if we're talking about $50,000, right?
Okay. Okay.
Okay. So let's say we entered here. Here is our first average. So let me make it right here. Okay. So we entered here, right here. All right. So this is our first average price.
Okay.
Then the stock moves up, let's say, right? And I take a partial, let's say right here, because it has moved a great distance, right? Okay. So let's say I take 200 shares off out of the 500, the 750. So I'm left with 500 shares, right? And already secured the profit. So what I would do then is I would trail the 10 and 20 moving average. And as you see right here, it became again tight and it gave another breakout. So what you could do right here is you could add to the next, the stock when the stock moves out of the new pivot, which is the $21 right here, and build a greater position. But the key difference here, as I said, is I free roll my adds. So when I add, my new stop loss should be above the new average created. So if I wanted to enter again on 21, okay, let me make it visual. So if I entered here, right, and I wanted to enter again here, remember I have 500 shares left, right? Okay. So if I added, this is the new average that I would create. This is the new average if I entered for the first time on this price. So if from 500 I add another 500 here, where will my new average be? Here, in the middle.
True.
If I added 1,000 shares, where would my new average be? Around here.
Right.
Somewhere around. Okay. So what I do when I have already a position and I want to add is I always want to, let's say I wanted to enter for the first time here, right? I would probably have my stop here. But since I have spent all this time waiting for the stock and I have some buffer, I want to leave it some room. So I will put my new stop loss around here, right? Because I want to give it some room for error. And this new stop loss is exactly the same as my average price. So if the stock doesn't go above here and what it did and went back down, I wouldn't lose any penny. Because my new average is here, right? So this is how you supercharge it, because from 500 shares, I was able to build 1,500 shares without risking anything, with a stop above or close to my average price, with a lot of room of error and potentially make big returns. So that stock from 21 went to 36 without a stop. So if my average was 19 up until 36, okay, so this is let's say don't want to say, let's say with partials it gives you around $8 or $10 profit. So if you had 1,500 shares multiplied by 8 or 10, it's $15,000. Compared to the $50,000, it's more than 30% increase of your account from one single trade because you supercharged your position.
Okay.
Right. So is this clear?
So your stop loss will be cumulative stop loss, including all the quantities. So 500 plus 500. So your stop loss will be one price, which will be stop loss for the entire quantity, right?
Yeah. And then if I get partials, of course I will move my stop along the way, right? I will gradually, I will track the 10 and 20 moving average, like I told you. It won't remain here, which was my average for all this time. Of course, I will
you add another 500 on the top?
Sorry?
Will you add another 500 quantity?
Where? Here?
Yeah.
Maybe not, because as you can see here, it violated the 20 moving average, which is one of my primary rules. So I would maybe have exited here.
Okay.
Right? So this is kind of, I try to be as condensed as possible. Of course, I didn't have the chance to talk a little bit about the second layer, but it's okay. I can
So,
always share
so for
another
that,
time.
I
And
need to take commitment from you
yeah, yeah,
that
yeah,
after we release this video, and I'm just going to do a stop screen sharing for the time being.
yeah, yeah, yeah.
Yeah,
Because all of this stuff that we talked about right now is all the first layer. It's
yeah,
just to have the knowledge in order. It's not the next level.
yeah,
So to have great performance year over year, you need something extra.
yeah.
So maybe we can have another time and
Yeah, so what I will do is that people who are going to watch this layer one, um, and people who stay till the end, because there's always a limitation of people who are serious about learning, right? There are
yeah,
more entertainment seekers than serious learners. So people who stay till the end, if they want the second layer to be discussed on the comment, please mention layer two. If you mention layer two, and if I get enough requests, then I will bother Marios again for another round of recording of layer 2. Right? Marius, thank you so much for this amazing content. While you were speaking, I didn't get much questions. Why? I mean, I'm sure you must be wondering that why he's not asking question. He's known for
yeah,
chit
yeah.
chat, chit chat.
But I told you I
Because
wanted to be quick and speed. So yeah,
yeah,
that's
but
because
but,
of
but
that.
the process was well defined. The document
Yeah,
was absolutely crystal clear. Plus, what do? I do the same thing. And I was like, how is it possible that two humans are thinking in a very similar manner? I mean, my YouTube channel has my entire process, and if you get to see that, you will understand, although it's in a native language, so you will not understand what I'm doing. But it's so similar because we
yeah,
all finally believe in that theory of riding a momentum stock, and relative strength is the core of our activity. So it's so good to know you and so good to see you following things which I also follow.
yeah. It's great, and I always believe that everything is universal. So I'm really happy about that. That I'm learning that you do some of the same things.
Yes, we all are learning from this market, isn't it? And you are at the right sweet spot. I mean, being just 26-year-old, you have the whole life ahead in terms of how much you can learn further. I'm almost 46 now, so but I still feel that there's so much to learn. I've not done justice to my 20 years of career in market. But best of luck for all your future endeavors, and I'm sure we will have one very successful hedge fund manager inside you who will someday come
Yeah.
out, and we will have some amazing literatures written on you. So let this be the video which defines that journey for you, and best of luck for your journey.
Thank you so much, Vivek. Thank you for your kind words and for inviting me to share my knowledge here. Thank you.
Thank you, brother. Thank you. See you soon.
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.